Symposium is a great platform for our clients to come to and really see some of the research that we're doing. They don't necessarily always on a day-to-day basis get an opportunity to see everything that we produce, talk to everybody, ask questions that they might have. And this really is a showcase for the organization about how is our research group doing, what are they working on, some of our thought leadership in different areas, as well as the firm thought leadership in general. On a day-to-day basis, we meet with our clients typically 4, 5, 6 times a year, and then we leave. And a lot of times they don't see a lot of our people within the organization. Well, we're doing a lot of different things, thinking about them every day, even though we might not be seeing them every day. So visiting the managers, sitting down in committee meetings, going out and visiting them, it's a good way to kind of communicate what's happening in the marketplace. But that's where we gain our institutional knowledge, is by talking with these investment managers, going out to visit with them. We learn a lot, just like we try to educate our clients, but we learn a lot from these investment managers about what's going on in the marketplace, because they're the ones in the market doing the buying and the selling every day.
Our base case is we see the U.S. economic growth continuing, although it may decelerate from the 4% pace that we've achieved. Overall, I think U.S. growth decelerating, but growth in the rest of the world picking up a little bit. That's our base case. The upside scenario would be related to continued expansion of this U.S. economic growth story into the longest in history. Downside scenarios, more sort of traditional end of the cycle. Labor market's tight, wages go up, the Fed gets nervous and raises rates too quickly. That can hurt the economic expansion. And then we have politics. And what would the midterm elections mean for policy going forward, and creating more policy volatility, particularly on the global scene in terms of negotiations with other countries going south. Those would be some of the wild cards to look for, more on the downside, creating more volatility.
So we saw there were 2 main causes to the financial crisis. First was the housing bubble. We saw a rapid increase in housing prices, which led to unaffordability, an eventual downturn in the overall housing economy, which filtered into the U.S. global economy. And then the other major thing was leverage in the financial systems. Banks became very aggressively leveraged in the years leading up to the crisis, and that meant they didn't have enough capital to deal with the slowdown in the economy that hit in 2007 and 2008. So where does that leave us today? I think one of the big things we think is people talk about the next 2008. I think if you look at the changes we've seen in the financial markets and the economy, the next crisis is likely to be a lot different than the last one we saw. And I think the other thing we hopefully can take from 2008 is at some point there will be a downturn in the economy and the markets, but I think the lesson we've learned is when you see that downturn, the risk is also likely to create some interesting opportunities.
The opportunities are really in the small buyout funds. We looked over 25 years, and the large funds that are being raised in the market today are great for the private equity market. They provide a solution to larger clients, but the opportunities are really in smaller buyout funds. These funds, over the past 25 years, have on average returned 18% annualized to investors, whereas the mega funds have returned less than 9%. We're in the early stages of this shift from public to private. Investors in the public markets are looking for opportunities. We've seen a persistent decline in the number of public companies. With more and more investors going into passive funds, they're looking to take that active manager investments in the private markets.
The value growth continuum is the cycle that value and growth stocks go through. So for instance, Microsoft in the late 1980s and 90s was a growth stock. Growth managers will continue to hold a growth stock as long as it is growing. But eventually, all companies hit bumps in the road, and that's where a value manager would buy a stock. Stick to your strategic asset allocation, and that's because everything moves in cycles. So similar to David Hernandez's talk last year, where he talked about the performance cycle between non-U.S. stocks and U.S. stocks, value and growth operate under the same dynamics. So we would expect at some point in the future, value would start to outperform growth.
China A shares are stocks that trade on the local Chinese stock exchanges. And there's 2 exchanges, predominantly the Shanghai and the Shenzhen. And over the last 15 years, we've seen some growth in terms of the number of listed companies with those exchanges. And recently, they've been added to some of the institutional benchmarks and portfolios. And it's a small piece right now, but if we look out over the medium to long term, we would expect this to continue to grow and become a bigger part of institutional portfolios. So we want to talk to our clients now about it so that they're ready for when that happens. At this point in time, we would not recommend a dedicated allocation to China A shares, but we do think that it makes sense to have some stock-by-stock exposure and a broader emerging markets equity allocation, as it can be a good source of alpha.
We did a deep dive into how much duration we should take in the markets. And it's based around the notion that because the Fed is going to continue to hike rates, and we're going to see the European Central Bank hike rates as well as the Bank of Japan soon to follow, there's a lot of talk about how we might want to shorten our duration. I would say, based on the macro environment and all of the credit fundamentals that we're looking at, ranging from leverage to coverage to use of proceeds, as well as where the yield curve is right now, we are roughly at the seventh inning. We've been at the seventh inning for quite some time now. We actually came pretty much to the ninth inning during the 2014 to 2015 shale crisis, but we've come right back to the seventh inning because spreads are quite tight. And so, going back to what we would recommend, because we're at the seventh inning, we're pretty close to the end of the credit cycle. We'd want to advocate being moderate in terms of both duration and credit risk.
We think that the impact of the tax law will probably benefit GDP somewhere between 50 and 75 basis points. The ultimate impact is not yet known. It'll take a little bit of time for the economy and markets to digest all the provisions of the tax cut. But most projections we have seen forecast a 50 to 75 basis point pop to GDP. And we think it could be tough for fixed income. If interest rates have to rise to finance a greater deficit as a result of less tax revenue, that's probably going to be tough for fixed income. I think U.S. equities, particularly value stocks and small cap stocks, should benefit the most. For non-U.S. equities, perhaps a bit surprisingly, especially if rates rise, 3 out of the 4 last times that rates have risen, international stocks have done okay. So we think it's more good news than bad news for non-U.S. stocks. We think it'll be difficult for one side to win the U.S.-China trade war. If we look at the amount of imports from China, it's a greater dollar amount that we can impose tariffs on. But at the end of the day, a lot of those goods and services are used in the production process and ultimately consumed by people here in the United States. So we might be able to raise tariffs, but if we can't fill that supply void with a cheaper alternative, we may end up paying higher prices. So more than anything else, midterm elections have proven to be volatile years in the equity markets. You see a pretty notable correction in most midterm election years going back to 1962. That's the bad news. The good news is the subsequent one-year return tends to be pretty strong. So hard to guarantee that'll happen this year given where we are in the equity market cycle and where valuations are and how long this bull market has been. But in most cases, it's been a volatile year, but ended up the next year has been very positive. In talking with Professor Thaler this afternoon, we spent a lot of time talking about the impact of behavioral economics on a number of different decisions and fallacies that investors fall prey to, like firing managers too soon, hanging on to investments too long, buying investments at the top of the market and selling them at the bottom of the market. So a lot of issues and client issues we deal with on a daily basis, but it was really refreshing and really insightful to be discussed by an expert in the field.
The evidence from portfolio managers and from both kinds of football is that firing the manager doesn't always work. In the case of portfolio managers, plan sponsors who fire the manager, on average, hire a manager who does worse over the next few years. So take a deep breath and make sure there was a reason you hired that guy in the first place, and make sure that hasn't gone away. Automatic enrollment, automatic escalation, and a good default are the essential 3 pillars of any good plan. If you haven't adopted those, you're not doing it right. But even if you have automatic enrollment, many firms are starting too low. 3% is not a good place to start. I recommend 6. And automatic escalation, it can go up faster, and it should be automatic. So auto escalate. And watch out for putting company stock into the plan, especially foisting it. There are still companies that pay the match in company stock. That's not a good idea. Bear Stearns, who's no longer with us, their employees were heavily invested in company stock in the pension plan. So you lose your job and your pension all in one day. Whenever I ask to sign a copy of my book, Nudge, I always sign it Nudge for Good, which I intend as a plea, not as an expectation, because people can nudge for evil, both the government and the private sector. And recently I've coined a new term, sludge, which is evil nudging, making things hard, making it hard for people to do the right thing, making it hard for people to get out of some contract. Keep your eye out for sludge. And if you're a perpetrator of sludge, cut it out.